The moment resale value stops protecting you. If you're counting on resale value to get you out of your car later, this is the part you haven't been shown. Here's what nobody tells you about resale value. There's a moment, a very specific moment, where it stops being your safety net and becomes a trap door. And right now, 26% of new car buyers are already past that moment. They just don't know it yet. Some of them are you. So let's talk about when resale value actually stops protecting you, because it's probably sooner than you think. Section 1, the promise. Let me take you back to the sales pitch. You're looking at cars, you've done your research, and everyone, the dealer, the YouTube reviewers, your financially responsible friend, they all say the same thing. Make sure it holds its value. Resale value. It's supposed to be your insurance policy, your exit strategy, the thing that protects you if life happens and you need to get out. Honda Civic, great resale value. Toyota Tacoma holds value like gold. Even luxury brands brag about their certified pre-owned programs and residual values. The pitch is simple. Buy smart, and the car protects your money. If you need to sell in 3 years, you'll be fine. If you get into an accident, you're covered. If your financial situation changes, you have options. It's sold as freedom, financial flexibility, as safety net. But here's the thing about safety nets. They only work if they're actually there when you fall. And for millions of American car owners right now, that net has a hole in it the size of a car payment. Section 2, the first moment. So when does resale value stop protecting you? Moment number 1, the second you drive off the lot. I know. You've heard that cars depreciate. Everyone knows that. But let me give you the actual numbers, because this is worse than you think. Your brand new car loses at least 10% of its value in the first month. Not the first year, the first 30 days. That's roughly $3,000 to $5,000 that just evaporates. By the end of year 1, you're down 20%. Now here's where it gets interesting. Let's say you put down $3,000 and financed $35,000. Your first year of payments, you're paying mostly interest. Maybe you knock off $4,000 from the principal. If you're lucky, your car is now worth $32,000. You owe $31,000. Congratulations, you have $1,000 of equity on a car you paid $38,000 for. But wait, you haven't hit the moment yet. Section 3, the trap springs. The moment resale value stops protecting you isn't when you have a little equity. It's when you have none. It's when you cross into negative equity, when you're underwater, when you're upside down. All different names for the same nightmare. You owe more than your car is worth. And here's what the research shows. You can be underwater from day 1. Not because you bought a bad car, because of how you bought it. In other words, long loan terms. 84 months is now over 21% of new car loans. That's 7 years. You know what happens in 7 years? Your car loses 50% to 60% of its value. You know what happens to your loan balance in those first 3 years of an 84-month loan? Almost nothing. You're treading water while the car sinks. Add in a low down payment or negative equity rolled from your last car, and you're underwater before you even leave the finance office. And this is the moment. This is when resale value stops protecting you, because now, if something happens, say you need to sell or the car gets totaled, or you want to trade up, you don't have options. You have obligations. That safety net you paid for, it's not there. You're in the hole. And you can't climb out by selling. Section 4, the scale of the crisis. So how bad is this right now? In the second quarter of 2025, 26.6% of people trading in cars toward a new purchase had negative equity. That's the highest it's been in 4 years, but it gets worse. Another study from late 2024 shows 39% of financed car owners are underwater, not trade-ins. All financed vehicles, that jumped from 31% in just 1 quarter. Let me put that in perspective. 2 out of every 5 people who financed a car owe more than it's worth right now. That's not a niche problem. That's not financially irresponsible people making bad choices. That's mainstream American car ownership in 2025. And all of these people bought cars thinking resale value would protect them. It didn't. Section 5. What it actually means. Okay, but what does this actually mean in practice? Let's say you're one of the 39%. You owe $15,000 on a car worth $10,000. You're $5,000 underwater. Scenario 1. Your car gets totaled. Insurance pays you $10,000. That's what the car is worth. You still owe the bank $15,000. Unless you have gap insurance, you now owe $5,000 on a car that's been crushed into a cube. You're making payments on nothing. Scenario 2. You need to trade up. Your family's growing. You need a bigger car. The dealer offers you $10,000 for your trade-in. Great. Except you owe $15,000. That $5,000 doesn't disappear. It gets rolled into your next loan. So now you're buying a $30,000 car for $35,000. And the cycle starts over deeper this time. Scenario 3. You want out. Job loss, divorce, moving. Life happens. You need to sell. Private party, you might get $11,000. You still owe $15,000. You need to come up with $4,000 cash just for the privilege of not owning a car anymore. This is what it means when resale value stops protecting you. It's real money you don't have, paying for a car you can't keep or can't sell. Section 6. The Hidden Accelerant. But here's what makes this worse. You probably don't even know you're underwater. Most people don't check. You're making your payments. The car runs fine. You're not thinking about trading it in, so you have no idea what it's worth versus what you owe. The gap widens while you're not looking. Because here's the thing about depreciation. It's not linear. Your car doesn't lose the same amount every year. It front loads the loss. Year 1, 20% gone. Year 2, another 15%. Year 3, another 10% to 12%. That's 45% to 47% in 3 years. Meanwhile, on your 84-month loan, you've paid down maybe 30% to 35% of the principal if you're lucky. The math isn't working. And every month, it works a little less. So by the time you realize you need that resale value protection, by the time you actually need to sell or trade, you discover you're trapped. The protection stopped working 2 years ago. You just didn't know it. Section 7. The trade-in trap. Here's where it gets really ugly. Remember those 26.6% of trade-ins with negative equity? The dealers know this. They've been dealing with this for years, and they have a solution. They roll your negative equity into your next loan. You owe $15,000 on a car worth $10,000. They're rolling that $5,000 gap into your new $30,000 car loan. Now you're financing $35,000. But here's the thing. You're financing $35,000 on a car worth $30,000. You start underwater again. And if you did an 84-month loan again, you're going to be even more underwater in 3 years. This is how people end up $50,000, $60,000, $70,000 in car debt on vehicles worth half that. Section 8. When it doesn't matter. Now let me be clear about something. Negative equity isn't a crisis if you're planning to keep the car. If you're going to drive that car for 10 years, pay it off, and run it into the ground, being underwater in year 3 doesn't matter. You're not selling. You're not trading. The resale value is irrelevant. The problem is that most people don't do that. The average car ownership period in America is about 6 years. People trade, people upgrade, life changes. And when you need to make a change, that's when you discover whether resale value is protecting you or trapping you. If you're underwater, you don't have flexibility. You can't pivot. You can't downsize to save money. You can't upgrade without digging deeper. And the thing about financial traps is that they feel fine right up until the moment you need to escape. Section 9. The warning signs. So how do you know if you're past the moment? Ask 3 questions. 1. How much do you owe? Log into your loan account. What's the payoff amount? 2. What's your car worth? Go to Kelly Blue Book or check recent sold listings. Not what you hope it's worth, what it would actually sell for tomorrow. 3. What's the gap? If you owe more than it's worth, you're underwater. That's the moment. You're past it. And if you're more than $3,000 underwater, you're in trouble because any unexpected event, accident, breakdown, life change is going to force you into a bad financial decision. Here's the thing most people don't realize the dealer and the bank don't care if you're underwater. They get paid either way. They're not tracking your equity. That's your job. And if you haven't checked in 2 years, there's a decent chance you're in the 39% right now. Look, here's the bottom line. Resale value is sold as protection, as a safety net, and as financial flexibility. But for 39% of financed car owners, it's not protecting anything. It's an illusion. A number on a screen that only matters when you need it, and when you need it, it's not there. The moment resale value stops protecting you is the moment you cross into negative equity. And in 2026, that moment is coming earlier and hitting harder than it has in years. If you're shopping for a car right now, here's what matters. Not just resale value, but how fast you build equity. Bigger down payment, shorter loan term, buy used instead of new. These are the things that keep you above water. If you already own a car, check your equity. Know where you stand. Because if you're underwater and you don't know it, that's when you get hurt. And if you're thinking about trading in, run the numbers first. Because rolling negative equity into your next loan is how you turn a $5,000 problem into a $15,000 one. Resale value matters, but only if you have it when you need it. For a lot of people right now, they don't. Don't be one of them.